structure, organization, processes, procedures, and systems in the fund industry have changed dramatically in the last few years because of the requirements from the regulator and the increased demand for governance from the investors, especially the limited partners. Hello, everybody. Welcome to this YouTube channel. I'm your learning partner, Sushila Hariharan. And if you're interested in a career in investment banking, global markets, and hedge funds, do subscribe to my YouTube channel where we provide content rich, research focused videos on these topics. A big shout out to Ulama, who has asked me twice on my YouTube channel to please make a video on the distinction between fund accounting and fund management. Here we go. So let's understand the structure of a fund. A fund now has been bifurcated into two distinct separate activities, quite like investment banking, where there is front office, middle office, and back office. Even hedge funds have followed a similar kind of structure, a similar kind of segregation of duties and responsibilities between fund management as well as fund administration. Okay, so let's talk about what is fund management. To understand the perspective of what is a hedge fund is a pool of funds that is collected from large amounts of capital from different limited partners, and this capital is then invested across countries in different assets in different currencies. The hedge funds use this large amount of capital from limited partners to then generate profits for the fund, and they return back the profits by way of profit distribution to the different investors. There is an investor allocation mechanism that is followed on the hedge funds that is largely focused on pooling the capital from a large number of investors and then investing it according to the investment objective. So that's your hedge fund management. I've of course made it into a very brief content because it is really a much more complex mechanism. The hedge fund is generally divided between the general partner and the limited partner. The general partner forms the fund, they collect the capital from the limited partners, and the limited partners' only contribution to the fund is to contribute the capital. They really don't aggressively participate in the day-to-day operations. It's up to the general partner to therefore set up the fund, get the capital contribution from different limited partners, define the most important aspect of the fund, and that is the investment objective. What are they going to do with that capital that they've collected from the different investors? And then invest the capital in different asset classes, in different currencies, in different countries. All this makes it very dramatic because a hedge fund is not just investing on the basis of gut feel or tips and hearsay, but they focus very exclusively on investing on financial reports, on equity research reports, on commodity research reports, on debt research reports, and then make investment decisions. Now this is very important because the investors, that's the limited partners who are investing into the fund, will invest only on the basis of what is the investment objective of the fund. If the investment objective does not align with what the limited partners want, then they may not want to contribute the capital. So the general partner therefore is largely responsible for setting up the fund, putting in a team of research analysts, quant analysts, technical analysts, and setting up the fund, into designing the investing strategies, deciding asset allocation, portfolio management, etc., for which the general partner then charges the limited partners the management fee. If the general partner has outperformed the market, it has done better than the hurdle rate, it has done better than the benchmarks, it has even pierced the high water mark, then the hedge fund can also ask for performance fees. So the fee structure of 220, that is 2% of assets under management as management fee, and 20% sometimes, which is the percentage of the performance fee for the outperformance beyond the benchmark or beyond the hurdle rate, is a pretty standard fee structure that is formed. So this is fund management. Fund management does everything related to setting up the fund, starting the fund, collecting the capital from limited partners, putting up a team of research analysts, technical analysts, quant traders, algo traders, putting in place asset allocation strategies, putting in place a portfolio management strategy, and thus designing everything with related to money. But this money is very fungible, and there have been several issues of corporate governance with respect to what has happened with capital contribution from limited partners at the funds. And therefore, now comes the very important aspect of how we control, how we monitor, and how we regulate the entire fund management process, that is now segregated into a separate activity called as fund administration. Of fund administration, everything related to accounting for the trades, which is a very important aspect of understanding what is the asset allocation, is an asset strategy, right? But how do you account for it? That is a fund administration job, where every trade that is recorded, that is done by the hedge fund, has to be recorded by the hedge fund. This recording of trades, accounting for trades, so that the fund is in full and total control of its assets, is done by fund administration. Fund administration comprises all the activities that relate to the legal processes, the accounting processes, the regulatory compliance reporting, as well as reconciliation by the back office to the hedge fund. This important aspect is extremely critical. It is very important that the fund remain in charge of its assets and cash balances, because frankly it has collected capital from different investors on the basis of that, and therefore it's important that this aspect of hedge fund industry is taken care of by the fund administration. Okay, what happens if one of the companies of the portfolio of the hedge fund has announced a corporate action like a bonus issue or a stock split, let's say a stock split? Then it is the responsibility of the fund administration to record the announcement and to ensure that the corporate action entitlement is received on the due date. Okay, so while the buying and selling of equities or bonds is done by fund management, the recording of transactions, the accounting of transactions, the compliance with the latest financial regulations and accounting regulations is done by the fund management team, by the fund administration team. I'm sorry. So the fund administration literally closes the loop, closes the circle on all fund management activities. Without fund administration, the fund manager will never have an up to date, authentic mark to market valuation of its portfolio. It will never have the entitlement, the trades that have been bought but not yet settled, the trades that have been sold but not yet settled. All these are important aspects of fund management itself, and therefore for the fund management to remain in full and complete control of its assets, that is the equities, bonds, commodities, foreign exchange transactions, and the capital that it has taken from different investors, it has to be in compliance with the regulatory requirements of the land. And therefore for all these purposes, fund administration, of which fund accounting is a very important aspect, have now been segregated. So everything related to corporate action collection, settlement of trades, as well as accounting for transactions, etc., account reconciliation of the books of the fund with the broker, with the counterparties, are all absolutely important aspects. If the fund has taken up OTC derivative transaction with a counterparty, then what is the requirement of the legal documentation, that is the ISDA documentation? Has the fund signed the legal documentation? What is the collateral management? All this risk, compliance, accounting, legal, are all taken care of by the large, very large fund administration team. So the fund administration team has to ensure that this circle of trading, circle of asset allocation, which is continuously happening in the markets, is settled, is in the nostro accounts, or is in the demat accounts, or is in the custodian accounts, so that the fund manager is then able to initiate the next trade. So fund management is more of trading of shares, bonds, commodities, foreign exchange by the asset management company, and fund administration is all about accounting, reconciliation, collection of corporate action entitlements, legal requirements, compliance requirements of the fund. Both of them work together so that the fund is in control of its assets, and they are able to give an updated information about their positions, about their trading positions, about their profits to the investors as and when they are demanded. Thank you so much, Olama, for the suggestion of this video. Appreciate it.